and welcome to The Money Show, your one-stop destination for all your personal finance queries. Today we have lined up a power-packed show for you, and here's what you should expect onto the show today. First up, with the continued outperformance in the broader markets, we will analyze that if this is the right time for you to book profits in the small cap space. For this, we'll be joined by Pankaj Murarka, who is the CIO at Renaissance Investment Managers. And next up to our second discussion, as monsoon havoc wreaks havoc across the country, we will discuss how you can save your car from the damage this monsoon. We will talk about the add-ons that you should consider to protect your car. We will be joined by Amjad Khan, Executive Director, Employee Benefits Practice and International Business at Anand Rathi Insurance Brokers. And finally, on our last leg, we'll throw upon the counter for you to get your mutual fund portfolio queries answered by Kaustubh, who is the Director of Fund Research at Morningstar Investment Advisors, India. So do send us your queries on our WhatsApp number, that is 865-797-4571, or you can also email us your queries on themoneyshow@etnow.tv. But before we begin our show, let's get you the top headlines of the hour. Nifty ends the day 0.5% up, but all eyes now on Fed's decision later tonight. A 25 basis point hike is expected even as inflation dips below market estimates. Bajaj Finance results in line with expectations, with AUM growing 32% YOY. Axis Bank profits jump 40% YOY. Sources say Qatar Investment Authority could pick up 1% stake in Reliance Retail for $1 billion. Reliance share upbeat. Next GST Council meets likely on August 2nd, says sources. A discussion on framework for 28% GST on online gaming is likely. Centre halts supply of rice for ethanol production days after it banned export of non-basmati rice. Distillers feel the heat even as sources say the move is temporary. Lok Sabha Speaker Om Birla admits no confidence motion moved by opposition against the Modi government. The government is unlikely to face any difficulty though. Welcome, you're watching The Money Show with me, Shrishti Sharma. And first up, onto the discussion, we'll talk about the outperformance we have seen in the broader market space. And is this a time to book out profits, or you should continue to rally on? Because Indian equities markets have seen a bull run in the recent times, with benchmark indices hitting the fresh life highs. In fact, Nifty is on the verge of breaching that 20,000 mark, still some points away. But during this rally, if there's one space that has outpaced the benchmarks, it is definitely the small cap space. Now the big question is this a right time to book profits in small cap, or will the rally in the broader markets expected to sustain going ahead? Let's answer all of these questions with Pankaj Murarka, who is the CIO at Renaissance Investment Managers. Hi, very good evening, Pankaj. Thank you so much for your time to ET Now, and pleasure having you. Firstly, when we see the outperformance of the broader markets, how do you see this? Do you believe that the bull run of 2020 or 2021 post-COVID is once again back with the same feel? And how do you spot the broader market space? And along with that, is this a right time to book profits, or one should stay invested?
Well, good evening, Srishti. I think there are multiple questions in your one question, so let me address them one by one. I and we firmly believe that the bull market that started post-COVID, what you were referring to, is very much intact. What we had between November 21 and let's say March of this year was more of a consolidation in the long-term bull market, and the same bull market continues. And the fact remains that Indian economy is delivering pretty healthy growth, and the outlook continues to remain reasonably strong. despite headwinds and turmoil globally. So I think the bull market in equities is pretty much live and kicking to my view. And in that context, given the fact that earnings growth for corporate India and for Nifty companies has been reasonably strong, I'm not surprised that index has touched 20,000. So the broader outlook on the equities continues to remain positive. I don't think so. Well, yes, markets are at all-time high. But having said that, the fact is corporate profits are also at all-time high. Corporate profits are still growing at mid to high teens. So in that context, I think investors having a medium-term view, for them, the outlook on equities remains positive or constructive in that sense. And I don't think so there's any need or reason for investors to take money out of equity. Having said that, what I really feel somewhat concerned is about the move that we have had in the small caps. So I think that's one space where the move that we've seen in stock prices across small cap indices has been pretty sharp over the last few months. And I think it's not a bad idea to reallocate some money from small caps to large caps so as to reduce the risk of the portfolio in that sense. Because all of us know that when markets rise, small caps rise much more or much higher than large caps. But having said that, when markets correct, small caps also fall much more sharply than large caps. And there are pockets of small caps where we can see some froth as well in terms of valuations. So I think the overall bull market is very much intact, but it's not a bad idea to reallocate some money from small caps to large caps so as to reduce the risk of the portfolio.
Pankaj, totally take your point, but just wanted to get a sense on, at this point in time, how do you spot the pockets that look overvalued to you right now? Because if I see the Nifty small cap index, then a couple of sectors that have seen amazing moves in this 1 year or so is definitely the aviation, definitely the defense space, as well as the railway stocks. What's your view on specifically both of these sectors? Do you feel that given the valuations that these are trading in, they are somewhat stretched and a good time to book profits in this one?
So, well, medium term, longer term, we like both the spaces because there are very strong underlying growth tailwinds for both the sectors, both defense as well, because India is focusing now more and more on indigenization of our defense, which effectively means 80% of our defense goods were imported, and we want to reduce that dependence and manufacture more at home, which effectively means domestic companies and defense manufacturing will do well. And likewise, railways is on a mega investment cycle that we have not seen in the last 70 years in India. The magnitude of investments that the railways are going to make over the next 15 years will exceed the cumulative investment that we've made by railways in the last 75 years. So that puts things in context. Having said that, again, coming back to small caps per se, when we're looking at small caps, it's more stock specific than sector specific, because many times we see very divergent performance from two companies within the same sector as well when it comes to small caps, because these are small companies. So a small improvement can have significant positive benefit or impact on their operating numbers in terms of revenues and profits, and vice versa as well. So when it comes to small caps, one has to take a more stock specific view. And if you look at the aggregate small cap valuations, let's say when you refer to Nifty small cap index and so on, I think those valuations are now trading at the upper end of where they have in the last 15, 20 years. And mind you, while we remain positive on the market, the fact is this bull market is now matured bull market, because now we are in the fourth year of this bull market. So the general investment philosophy is, as you move towards deeper into the bull market, or as the bull market sustains longer, you keep cutting your small cap exposure and move that money to large caps so that you keep reducing your portfolio risk. Because the fact is, when markets fall, small caps will fall much, much more than the large cap indices.
Okay, Pankaj, though the long-term view on the Indian equities definitely remains to be positive, but in the near term, do you spot any headwinds for this up move? Do you believe that maybe the Fed decision or something else, because till now the corporate earnings haven't been that great to give a push apart from a couple of names like L&T maybe? So apart from that, do you believe that there's any red flag that the investors must be missing out on, probably the time to book profits in some pockets, which you have been highlighting that the stock specific movement they should be tracking per se when it comes to small cap?
So one, I think as far as impact of US Fed moves on markets globally and on Indian markets is concerned, I think probably in all probability today there'll be another 25 basis points rate hike by US Fed. But having said that, I think that's already priced in into equity as an asset class globally as well, and as well as in India. So I don't see that having any negative rub off on equities in any ways. Having said that, as I said, see, to put things in context, a lot of these small cap companies are now operating near full capacity, which effectively means the operating leverage in their system has been completely exhausted or significantly exhausted. And now from here on, these companies will have to start investing into creating new capacities, or they will have to get into investment phase. Generally, when small cap companies get into that investment cycle, their return ratios and tends to moderate, and they tend to use their free cash flows back into investments, and as a result of which there's some impact on their operating numbers in the near term. So I would think that there are pockets where we've had very sharp moves in small caps, essentially, as you said, especially in the capital goods sector, where we see in some sectors, especially capital goods, where the underlying growth is strong, including some of the railway names and defense names you said. Uh, some of the small cap companies are trading at valuations which are more expensive than the large cap companies. Now, that is something which is a dichotomy, I think, which cannot sustain over a longer period of time. Similarly, in engineering and capital goods space as well, that there are small cap companies which trade at significant premium from a valuation perspective as compared to the large cap peers. And which is where I feel that it's not a bad idea to take some money out of these small cap companies, because the stocks have done exceedingly well over the last 6 months and last few years. Many of these stocks have become like 10, 20 baggers, and now they are trading at valuation premium to large caps, which certainly is not sustainable on a long-term basis, and probably redeploy that money to large caps where the risk is significantly lower.
Pankaj, but since you have such a rich experience in equities and we have you onto the personal finance show, like you were highlighting one point that maybe the valuation comparison between the small cap and the large cap space is something that you watch out for, and you believe that this is not sustainable in the long run. But other than that, if I may ask you, which are some of the top five points that you look into one company, probably in a small cap, before investing, and as a thumb rule, which five areas that the company or the financials of the company should justify before you enter?
So, okay, very interesting question. So, essentially, one will look at, I think the first thing I would advise investors to look at is look at the balance sheet of the company. You want a company which is not significant, which does not have significant leverage or debt on its balance sheet. You want company with strong balance sheet, because remember, these are small companies. So, and every 5 years, let's say, there will be some crisis locally or globally, and these companies need to survive economic crisis. And because they are small, they tend to be more vulnerable as compared to large companies. A lot of small companies failed during COVID crisis. So I think the first and foremost thing is to buy a company with rock solid balance sheets with very low leverage or moderate leverage is one, I would say. Secondly, then try to understand have some understanding of the business of the company in terms of its growth prospects. You want that company to be growing. So, for example, let's say I'm saying for a normal investor, if you walk into a departmental store, you like some product which is manufactured by a small cap company, for example, let's say uh, uh, I had some investor who bought some cakes which were made by Bector Foods, and it was a small cap consumer company, and he went and bought Bector Foods after seeing the balance sheet of the company. So try to get some understanding of the business of the company, and third thing I would look at is the valuations in terms of what are the earnings of the company and where the stock is trading in terms of P multiples and this thing. Fourth, try to do some due diligence on the reputation of the company, the business, and the promoter, and which can be done through some basic or primary research, I would say. And finally, I would say in small cap companies, look at their dividend track record, because good companies, even if they are small, tend to have a long track record of paying good or healthy dividends to shareholders, which effectively shows that company is shareholder friendly. So from a uh, uh, investor's perspective, probably these are the 4 or 5 things that I would look at before investing into a small cap company.
Thank you so much, Pankaj, for highlighting or jotting down all of those points. I'm sorry, I know that you weren't prepared for this one, but you briefed it up very nicely for all the retail investors probably looking out to invest afresh in small cap companies. But lastly, Pankaj, just wanted to understand, we did touch upon a lot of sectors that may be looking overvalued or not. This is something that investors should know. But at this point in time, any sector that is still looking bullish to you, we know that your preference recently has been in the new age technology companies. But other than that, anything that is looking interesting right now to you?
So we have been underweight traditional IT services for some time, for almost 2 years now. So we've turned positive on IT services because we think the fears of a sharp contraction or recession in US economy have turned out to be not true in that sense, because the US Fed has done such sharp rate hikes over the last 18 months. And yet the US economy is holding very well, and it's been very resilient. And we think we think IT spending will come back with very strongly in the second half of this year and going into next year. So IT services is one space where we've been somewhat cautious over the last few years, but we've turned positive. And second thing we have started liking is auto ancillaries, because the whole auto space was impacted because there was a shortage of chip supplies over the last 2-3 years post-COVID because of the resurgence in demand for automobile vehicles. Now chip supplies have become normalized, so there is an increased production from OEMs across the board, and the auto ancillary companies will be a big beneficiary of that. So auto ancillary and IT services is the two sectors that we have started liking, and we find valuations in both the spaces are very reasonable in that sense.
Pankaj, always great to have you on the channel, and thank you so much for all your time to the Personal Finance Show, the ET Money Show. It was great having you. Thank you so much.
Thank you.
So that was Pankaj Murarka sharing his outlook on what to do in the small cap index. And at this point in time, what space is looking interesting is the IT space as well as the auto ancillary space. That maybe with the points that we tried to highlight, that what all you need to look before investing in any small cap company, then you can do your own due diligence and invest in good companies. But with this, viewers, it's time to slip into a short break. But don't go anywhere. We'll be right back with more. Welcome back to the Money Show, and on to our second discussion. We will actually shift focus to what all you need to keep in mind to make your car monsoon ready, because comprehensive car insurance covers the damage and the losses to your insured car due to natural calamities, but it does not cover the damages due to waterlogging or floods. And with the monsoon wreaking havoc across India, it is time that you make your car monsoon ready. On the Money Show today, we will discuss what kind of the add-ons that you can consider to protect your car from the damages caused during this season. Let's welcome on board Amjad Khan, Executive Director at Employee Benefits Practice and International Business at Anand Rathi Insurance Brokers. Hi, very good evening, Amjad, and thank you so much for joining us today on ET Now. We will definitely talk about the add-ons and how one should make their car monsoon ready. But with the monsoon that has already happened in major parts of India and damaging not just the property, but other than that, the cars as well. And we have seen across India that there were so many videos, so many footages of cars just going up in the way like a river. And at this point in time, just wanted to understand that what should a consumer or the car owner take in mind or consider in mind whenever they are stuck in such kind of a situation? What all things get covered in the insurance and what all not?
Yeah, thank you so much for inviting. Good evening. So yes, we have witnessed a lot of monsoon chaos in the last rather 10 years. In fact, I would like to bring to highlight one thing, that next 10 years, what we are going to witness in terms of the top two discussions the world is going to go through is, one is AI and second is climate change. So we'll leave AI aside and look at climate change, because that is something which we have been seeing incessantly increasing every year on year. And India is no exception to that. We have seen how the rains have impacted every year for the last 10 years. You have seen the impact. But this year, 2023, happens to be north of India, where we have seen flooding all across the entire northern region of our country, and we have seen the amount of chaos it has created. This is going to continue because the climate change starts with a lot of slow process, and it's something that's going to it's not going to change overnight. So we got to be better prepared there. And with all these floods coming in India, the National Disaster Management Association has declared India to be a flood-prone country. And now coming back to motor insurance, we got to ensure that motor insurance is adequately covers everything possible, because the losses could just run into detailed one, which could be even a total loss as well. So now in the monsoon time, especially in the monsoon time, we have to ensure a couple of things which are really, really important. One is the protection of your engine, which is called as the engine protection cover. This is the most critical add-on which we should have under a car insurance policy. So what this does is it protects the engine in case of any water ingestion happens in the engine, because of which the engine seizes completely. So that's a big dent onto our savings. And if that is not a part of your comprehensive insurance policy, that could be a big dent to us. So engine protect is a very critical cover we should have during all times, especially monsoon, where flooding can hamper your car claims. The second most critical add-on under the car insurance policy, I would suggest, is to have a 24/7 roadside assistance. So I think this is one thing which is very critical, because wherever your car just breaks down or it stops because of XYZ reason, when you have a 24/7 roadside assistance extension, a ride-on cover like this, your car can be immediately towed back to the nearest garage and get it repaired. So the hassle of moving to the right place to get your car repaired is removed off if you have a 24/7 roadside assistance. Third is emergency evacuation of your car. That simply means that if you're 100 kilometers away from the radius of the city and sudden breakdown happens there is an assistance if you have this extension onto your car policy, where the car can be picked up and taken to the nearest possible garage for it to be repaired. So these three are the most critical components to be looked at, especially during monsoons, because this can happen to anyone at any place across. Now, the other couple of things which I would like to highlight is, one is your invoice return to invoice value. So that's very important here, because what happens in case of a total loss or a situation where it is beyond repairs, the cost can be reinstated back to the invoice value, which basically saves you from any additional output from your pocket, and the return to invoice value takes care of that. Yes, your car insurance policy should also have an add-on like a zero depreciation, which basically takes away the depreciation cost from you, and the insurance company reinstates the value minus the plus including the depreciation of the car during a claim. And consumables, that's another very important cover which we should look at as an add-on. So basically this will cover things like your nut bolt, your clutch plate, gearbox, and all those stuff which are usually not covered under the policy. So the consumable coverage also plays a very important role to make it a comprehensive car insurance policy.
Okay, Amjad, so you just jotted down a lot of points there, that what all a consumer needs to take care of when they are taking a new policy. But taking a policy and the comparison between the existing policy and maybe some add-ons over there. But Pankaj, whenever a person is stuck, what we are getting to understand is that whenever they are stuck in a flood-like a situation, the suggestion is that not to put on or turn on your engine. Is that the case, that investors or the consumers rather, they really need to take care of? And any advice on that?
Yes, so that's absolutely right. Especially when the car is in a flood-like situation, we should never set our engine on, because there's something called hydrostatic impact on the car, which completely disables your engine for permanently. So that's why it's not advisable whenever the car is in a situation like that. We should never on our engine. So That's the first mandate which the insurance company will give you whenever you take an add-on of the engine protect.
Okay, that's understood, because all of these things were getting really viral whenever we are stuck in a flood-like situation like this. But I'm just wanting to understand that you did touch upon a lot of add-ons, but exactly how much costly or how much pocket-heavy these add-ons could be, if you can just give us some idea on that.
Yeah, so before I come to the approximate pricing on the add-ons, I think it's very important for us to understand what is the average price of a insurance policy, motor car insurance policy. So looking at that, whenever we buy a new car, approximately 2% of the showroom price is what your insurance price would be. So that's the range it falls into. And if we take ahead that, if we assume that we take all the add-ons which we discussed, which are essential, so probably 0.5% of your showroom price would be the cost of taking all the 6 add-ons under your comprehensive car insurance policy. Somewhere around it, if I have to put that into numbers, a car worth 20 lakhs would cost you around 6,500-7,000 rupees for these 6 add-ons.
Okay, Pankaj, and is there any criteria on the time period as well? Because if somebody is shifting from one place to another and maybe that area is not prone to flooding, can this add-on be removed? Anything on that?
No, once you have opted for an add-on, that stays till the continuity of your policy. Once the policy comes up for renewal, probably then you can look at if you want to eliminate. But I don't think there's a reason why anybody would opt out of an add-on, because these got to stay in the policy, because situations are very uncertain in the last 10 years. Barring 1 year in the last decade, there has been surprises all across in cities where they had never experienced any kind of flooding situation. You take Bangalore as an example, you take Delhi as an example, you take Rajasthan, there are multiple such examples. So I think once you opted for add-on, it's a great thing. We got to continue with it.
Once you have opted for add-on, you just need to continue on that. But Pankaj, in the add-ons and the list that you have shared, anything that the consumers generally tend to overlook and which is important in your eyes, anything that you wish to highlight on that particular front?
So we are a very price sensitive country, honestly. So the moment we talk about add-ons, people look at the price, what is the impact coming onto their pockets, and that, I think that becomes the most important deciding factor, apart from understanding the risk associated with your car insurance to have those kind of coverages. So if you eliminate that, I think the outlook should always be to ensure that your car is adequately covered at all times, because the moment we have a claim, I think we have a two-way loss. One, if we don't have the add-on, the amount of that claim goes from our pocket, and secondly, your next year when you renew the policy, your no claim bonus goes out of the window. So that increases the price during the renewals as well.
Before we let you go, and just to sum up this conversation, you did discuss upon a lot of add-ons, but amongst the list, which are some of the most important ones that the consumer should definitely not ignore, and maybe if they have to pay that 0.5% extra on their overall policy cover, then they should definitely look into that and look to maybe pay that money?
So according to me, the top 3 here would be engine protect, your 24/7 roadside assistance, and your emergency coverage beyond 100 kilometers of limit. These should be the top 3. While I say that, I don't, there's no importance which goes down to the other 3. They are as critical as they can, especially to return to invoice value is a great cover to have, wherein in case of a total loss or irreparable situation, the insurance company will put the claim back to the invoice value rates. So that's how on priority we should look at. But otherwise, I would honestly say every single component under the add-on covers is as critical as it can get, because it's just a matter of time when you have a claim under one of those.
Okay, thank you so much, Amjad, for joining us today on ET Now and helping all of viewers understand that how important it is to cover your car and get that monsoon ready, and maybe if you have to pay some extra money, then why you definitely should look at paying that money and getting all of these add-ons. Thank you so much for all your time.
Thank you so much. Thank you.
Yeah. So that was all the discussion about your car insurance and how to get your car ready for the monsoons, because we have already seen all the situation around India where the cars were getting washed away in a flood-like situation, and how you should definitely cover your car in such kind of a situation and be ready for the times ahead. But with this, viewers, it's once again time to slip into a short break, but don't go anywhere. We'll be right back, and then it's the time to take all your portfolio-related queries, so stay tuned for that. Welcome back to the Money Show, and this is the time where we get your mutual fund portfolio checked by the expert. And as we know that there are a plethora of funds available in the market to invest your hard-earned money, but how do you assess which is the right fund for your portfolio, and what are the criteria that one should look at to help you navigate through this maze? We have on board Kaustav Belapurkar, who is the Director of Fund Research at Morningstar Investment Advisors India. Hi, very good evening, Kaustav, and thank you for your time to ET Now. We'll begin taking all the queries, but just to give a small recap to all of viewers who are trying to connect with us, you can send your portfolio queries on a WhatsApp number that is 8657974571, or you can also email us your queries onto the moneyshow@etnow.tv. So let's move on, Kaustav, and once again, very good evening. Before we come to you, the first query is from a live caller, and we have online Prabhat from Jharkhand. Hi, very good evening, Prabhat. Go ahead. Kaustav is here with us to guide you better. Go upon and ask your question.
मैम हम तो अपना क्वेश्चन भेजे थे आपको.
Okay. Yes, the team has your question. You want me to read that? We were expecting that maybe if there's an add-on that you want to go ahead with, but nevertheless, we'll try to take your question. And Kaustav, what he is saying that from the last 1 year, he's been doing an SIP, and he also has shared his portfolio with our team. Firstly, he has SBI Small Cap, Quant Small Cap, where he's investing SBI Small Cap, he's investing 1,000, Quant Small Cap 10,000, HDFC Sensex India Fund 2,000, Motilal Oswal Mid Cap Fund 2,000, Mirai Emerging Equity Fund, there he's investing 2,500. He wants to know that what are the long-term prospects of these mutual funds where he wished to stay invested for the next 12 to 15 years and to save some money, or rather grow some money for his child.
Sure. So firstly, thanks, Shrishti, for having me on the show. And I think an interesting portfolio, and let me just break it down into several aspects about when we think about the portfolio that Prabhat has shared with us. First and foremost, it's good that he's planning for his child, probably for education or other purposes, and he's got a reasonably long-term horizon of 12 to 15 years. So that's great. But when I just look at the construct of the portfolio, it's very important to think about the context of how the portfolio is constructed, and what are some of the changes that we would look to make for this. So the first thing that stands out for me obviously is two things. One is obviously it is very, very mid and small cap heavy when you think about it. Obviously, by holding several small cap funds and a mid cap fund, and also a large and mid cap fund in the construct of the portfolio. Now we all know that equities is a great long-term asset class. Mid and small caps even more so can be great returns or generators of the long term. But when you think about portfolio construction, especially for a goal which is as sacrosanct as perhaps the child's education, where you can't compromise on the amount that you want to save or have ready at the time when your goal is ready, and you can't really compromise in terms of time frame. I mean, if you have to fund that goal 12 years down the line, you will have to fund it 12 years down the line, come what may, right? So I think in that sense, having a much more structured portfolio approach becomes even that more important for Prabhat. And I think the first thing I would recommend is, while you would want to have reasonable allocations given the long-term approach to this portfolio to mid and small caps, currently it's in excess of about 60%. So in lieu of holding the small cap and mid cap funds, I want to bring that down to about 40% of his overall portfolio. I think that's the first thing that Prabhat should look at doing. Secondly, the portfolio that he shared is extremely skewed towards one fund, which is the Quant Small Cap, right? So 10,000 rupees out of an overall SIP, about 17,500 is excess of about 57% going into one singular fund. I think that's something that Prabhat will need to prove, and obviously in line with what we spoke about, bringing his mid and small cap exposure down, I think he should definitely look to do that, because no matter, what you like about a fund or you don't, having, almost more than half your portfolio in a single fund, we all speak about diversification. This is an extreme case where you need to bring that down purely because I know the fund's done exceedingly well over the past few years, and there are reasons for that. But remember, every fund, every style will go through periods of underperformance, and you don't want to be too polarized in your portfolio towards a particular fund. So I would recommend bringing this value down to about 10 to 15% of his overall portfolio, no more than 15%. That's one thing that he should definitely look to do. In line with increasing his large and mid cap large and sort of large cap exposure, he should be looking to add either to the existing index fund he has, or he can look at some other actively managed large cap or flexi cap funds like the Mira Asset Large Cap, the ICICI Blue Chip, or the Kotak Flexi Cap, which will help bring his large cap exposure up to the desirable level of close to about 60%, like I was shared. Right. The other thing that Prabhat should definitely look to do. So he's started this about a year back. Which is great. But every year, don't stick with this current SIP amount that he has. Keep increasing that year on year. And I would say as a base case, at least 10% if financial situation allows even more than that, so that you can build a healthy enough corpus at the end of this 12, 15 years. So definitely step up your SIPs by at least 10% every year. And you would greatly benefit from, kind of investing in equities for the long term. And the third thing, which is very, very important to keep in mind, as you start approaching your goal, and we spoke about, that it's pretty sacrosanct in terms of timing and the amount of money that should be available to fund the child's goal that he has in 12, 15 years, start reducing your equity allocations as you come closer to your goal. And when I say come closer, maybe, when there's still 5 years left for your goal, gradually start reducing your equity exposure, bring it into fixed income. And why is that important? Because we all know equities can do well over the long term, but we have seen periods, for instance, COVID, where the markets fell in excess of 35, 40%. Now, there's no predicting that an event like this can happen again. I mean, we've seen enough market periods where markets have fallen in excess of 15, 20%. So to de-risk your portfolio, as you come closer to your investment sort of goal date, reduce from the volatile exposure such as equity and move into fixed income, which is more predictable, albeit with lower returns. But that will give you a much, much more smoother ride in terms of your overall portfolio expectations and allow you to meet your goals quite, confidently. So I think these are some of the contours of what Prabhat should keep in mind when he restructures his portfolio, in terms of an overall allocation and fund level basis.
Okay, Kaustav, thank you so much for jotting down that how he should plan to restructure his portfolio. But moving on to the next caller then, and Kaustav, this one too is the live caller, and his name is Nayan Patel. Hi, very good evening, Mr. Patel. Please go on. We have Kaustav on line live with us, and he will answer your query.
गुड इवनिंग, माय नेम इज नायन पटेल। मुझे जानना है कि मुझे 10 इयर्स में 10 करोड़ का कॉर्पोरेट इकट्ठा करना है, तो कौन से फंड्स में मुझे और कितना इन्वेस्ट करना होगा?
ओके, आपको 10 करोड़ का फंड इकट्ठा करना है, पर कितने साल में?
10 इयर्स में।
अच्छा, 10 years में। ओके, Kaustav, you heard his question. He wants to get his portfolio at a big amount, maybe in the next 10 years. So any fund that he can start investing in, and also guide him that what should be the monthly SIP amount that he needs to be looking at.
Sure. So I think, just doing some very quick back of the envelope calculations for the goal that Nayan has in terms of 10 crores over the next 10 years, after 10 years, I think, he would need to start with a monthly SIP of about slightly over about 2 lakhs a month. And with the calculation that at least a step up of 10% every year in SIP values, right? So even if you assume and build in all the buffers, and, like I was replying to the earlier question, that because there's a goal, when you approach your goal, you need to start moving away from equities into fixed income. So you will also build that into your return assumptions, right? So start with about, to be on the safe side, about between 2 to 2.25 lakhs a month. Increase that by 10% every year. And when you're about, 6 years into your investment goal, so closer to 2029, 2030, start reducing your equity allocation. So today, you can start with close to about 100% allocation, maybe about 5% odd in cash for emergencies. But again, build a portfolio, which is, the core of the portfolio still remains in large and sort of flexi cap funds. with maybe about 35-40% in mid and small caps. And gradually, as we said, when you enter your 6th to 7th year of investment, start reducing your equity exposure. But you have to maintain that discipline of stepping up your SIP every year by at least 10%. If finances allow you more than that, great. But yes, it'll have to be an aggressive investment plan if you're starting today with a 10 crore goal in mind over the next 10 years.
Okay, Nayan, any more question that you wish to ask from Kaustubh? Does this answer your query?
No, I just know what they say. But startingly, initially, can you suggest me in which types of fund I have to start in the investment?
Okay, Kaustubh, you want to
And
take...
which fund I have to... Yes.
Yeah. So I would say, and like I was saying, so about 60% of your portfolio, Anand, should go into large and flexi cap funds. So there are a few names that, which are, I think, great to start with, like the Mira Asset Large Cap, the ICICI Blue Chip, the Kotak Flexi Cap, the Parag Parikh Flexi Cap. These, will form the core part of your portfolio. The remaining 35%, which goes into equities, 5% remains in, an ultra short-term fund for emergency purposes. The remaining 35%, about 25 odd percent can go between, say, a Kotak Emerging Equity, which is a mid-cap fund, a DSP mid-cap, another, exciting mid-cap strategy, and the remaining 10% is a small cap in the HDFC small cap. So this gives you exposure across the various capitalization buckets that we spoke about, and also gives you different styles of management because we've recommended funds from varying fund houses with different styles. So it'll give you a good holistic mix of funds, which will, evergreen your portfolio in a way that, as an investor, we've seen certain styles work at different points of time. And if you mix these styles, then you get a much more stable portfolio movement rather than very, very lumpy performance if you're running funds with a very similar style. So I think that's the other thing that is very important. And I think these funds that we spoke about will give you that good diversification mix across asset classes and styles. So I think if you do that, continue with the SIPs, step it up, you should comfortably meet your goal with the values that we spoke about.
Okay, so that was the solution coming in for Nayan. But moving on, and the last query that we wish to take onto the show, Kaustubh, is coming from Narayan. He's basically from Kerala but now settled in Dubai, and he shared his query through email. He says that he's 47 years old right now and having just more than 2 crores in the mutual funds, including the SIPs, and he's also invested in IIFL, PMS combined. He hopes to make it to 4 crores in the next 2.5 years' time, with a monthly SIP that he's looking is 1.5 lakhs, and some other savings are also there which he plans to invest. His plan is to retire after 3 years and take SWP of 10% annually from this 400 crores, which means that 40 lakhs annually he would be withdrawing out of this amount, and around 3 lakhs monthly for his regular expenses. His query is, will he be able to do this without touching his capital of 4 crores to meet his regular expenses after retirement? What should be the suggestion?
Yeah, sure. I think a very interesting question, and I think there are a few things very, very important to keep in mind here. So firstly, Narayan has, he's obviously accumulated a corpus which is reasonable of about 2 crores. He wants to get it to 4 crores, but when you think about the time horizon, right, it's just 2.5 years away. So the first thing when you think about it, and he's probably going to be adding 1.5 lakhs a month, for the next, 2.5 years, which would add up to another 45 lakhs. So just in terms of, if I just think of today's value plus the fresh investments that he'll make, about 2.45 crores. To be honest, 4 crores is an impossible target to reach in this time frame with whatever investment he makes, right? And we all spoke about how equities in the short term, it's an unknown animal, right? Today we're sitting at close to market highs, new market highs. Now we don't know 2.5 years down the line, and we've seen this, year in, year out, that markets can be 20% up, 30% up from here, perhaps if everything's good, or they could be 20-30% down in the short term, right? We don't know that. So his 2 crores could probably be 3 crores of markets are great, but it could also be 1.2 crores of markets correct for whatever reason, in the coming years. So I think that's one very important thing to keep in mind when you think about a final goal amount in mind, that you need to have a realistic expectation of where you're today and what can you potentially build it to, and also have the right time horizon, right? So I think, he will need to do a couple of things. One is probably look to extend his time horizon. So, if he's planning, he said he's going to retire over the next 2.5 years, probably look to extend that, and to be honest, probably by another 5-7 years at least, so that he's got a long runway to both saving and, kind of the investing time horizon. Right? And B, maybe can he rationalize his expenses to, lower his goal, right? That's one thing that he can think about doing if he doesn't want to stay on working for that long and maybe, prepone his retirement, right? That's one thing. The second and the more important thing is, thinking about how do I use that retirement corpus? I mean, assume that, he gets his 4 crores, maybe not 2.5 years, but he saves and invests wisely the next 7 years and gets his 4 crore corpus. You have to, account for several things when you think about a retirement corpus. One thing is that, we've spoken about getting a 10% out of this. Again, remember, 10% is not a feasible number from, on a consistent basis from a portfolio where you don't touch a capital value. Because, you can invest in fixed income, which will at best, in today's world, maybe give you 6.5%. We've seen in the past was even 5%, right? Which is less volatile. But if you invest in equities, you can't draw down 10% every year.
Sorry to interrupt you, Costa, but we are completely out of time in this edition of the ET Money Show. Just in one line, if you wish to sum it up, the last query.
Think about a safe withdrawal rate of maybe about 3%, which means, whatever his annual expenses, it can be 3% of his overall corpus. So I think that's that he should work with that math to derive how much he needs to save or how much he can spend in a month, depending on his end corpus.
Okay, thank you so much, Kaustubh, and sorry for interrupting because we are completely out of time in this edition of The Money Show. With this, it's a wrap, and it's a goodbye too from me and the entire team who put the show together. Thank you so much for watching.